Also right here on CBS 46 News at 11. Right now, after months of forecasts, it came as no surprise when the Federal Reserve increased interest rates for the second time this year. But while economists talk a lot about the impact on the markets, we wanted to know how it will impact you. I sat down with a Metro Atlanta tax expert who says the Fed's decision could affect everything from housing costs to student loans.
Rates have been low for almost a decade now, so it's about the time where the economy is probably strong enough.
And the market is taking notice. Just recently, the Federal Reserve increased interest rates. And while a quarter-point hike isn't a big one, if you're a credit card user or a homeowner, your debt could get more expensive.
People with a lot of debts obviously are going to basically suffer from rising rates, right?
Tax expert Andrew Poulos says variable rates on credit cards mean you'll pay more towards the debt. According to Wallet Hub, it'll cost credit card users about $1.5 billion in extra finance charges this year.
First and foremost, figuring out really where's your money going. Once you figure out where your money is going, then you need to look at and see how you can rapidly pay down some of the debt that has higher interest rates.
Homeowners with high adjustable rate mortgages could also see their monthly payments go up this year.
You probably obviously want to look at possibly refinancing to get your interest rate and your mortgage loan down.
And for those looking to buy a home, Poulos says now is the time to buy. The average 30-year fixed rate mortgage is around 4 to 4.5%. but likely to rise by the end of the year.
So it's in your best interest, if you're looking to purchase a house, to probably start looking now versus a year or two from now when interest rates might be at, 5.5 or 6 or whatever interest rate that we might see.
Rates are still very low compared to prior decades, but experts say they are starting to accelerate. Poulos says managing your finances now will lower your risk of a financial jam in the future.
Let's just say that you're paying right now $400 or $500 a month in credit card debt, minimum monthly payments. That could easily double, probably over the next 2 years as rates begin to rise.
So how about a course of action? If you're working to pay off credit card debt, Poulos suggests paying off cards with the highest interest rates first. And if you're really in a financial bind, like so many, he suggests calling the card companies directly to see if they can arrange a payment plan.